If I gave you two companies to invest in and they both made exactly the same profit last year, which one would you buy? The one with $20 billion in cash and almost no debt, or the one with $20 billion of debt and very little cash? The answer isn't in the income statement. It's in the balance sheet. If you're thinking about buying shares in a company, the balance sheet can quickly tell you whether that business is financially strong or carrying more risk than you realize. In the next 8 minutes, I'll show you exactly how to read a balance sheet, even if you've never looked at a financial statement before. This video is for educational purposes only and is not financial advice. Always do your own research and consider your personal circumstances before making investment decisions. Before we look at the balance sheet, let's take a step back. When you're thinking about buying shares in a company, there isn't just one financial statement to read. There are three. Think of them as three different views of the same business. The income statement tells you whether the company made a profit. The balance sheet shows what the company owns, what it owes, and what's left for shareholders. The cash flow statement shows where the company's cash came from and where it went. Each statement tells part of the story. Together, they give you a much clearer picture of the business you're thinking about investing in. Today, we're focusing on the balance sheet. When you buy shares, you're buying a small ownership stake in a business. Before becoming an owner, it makes sense to understand the company's financial position. Think of a balance sheet as a snapshot of a company's finances on one particular day. It answers three questions every potential shareholder should care about. What does the company own? What does it owe? What belongs to the shareholders? Every balance sheet is built around one simple equation. Assets equals liabilities plus shareholder equity. We'll come back to this equation throughout the video. To keep things simple, we'll use Costco as our example. We'll use simplified numbers so it's easy to understand how a balance sheet works. If you compare these figures with Costco's published financial statements, you'll notice they're different, and that's intentional. The goal is to understand the concepts, not memorize the exact numbers. Let's build Costco's balance sheet, one section at a time. Let's start with assets. Assets are everything the company owns that has value. If you buy shares, these are the resources the business uses to generate future profits. For Costco, that includes cash, inventory, warehouses, equipment. These assets help the company generate future profits and grow the value of the business over time. Not all assets are the same. Current assets are expected to be turned into cash, sold, or used within the next 12 months. Examples include cash, inventory, and money owed by customers. Non-current assets are long-term assets the business expects to keep for many years. These include land, buildings, and equipment. Companies with more current assets than current liabilities are generally in a stronger position to pay their short-term bills. Next come liabilities. Liabilities are the company's debts and financial obligations. Like assets, they're divided into current and long-term liabilities. Current liabilities are bills that must be paid within the next year. Long-term liabilities include loans that may take many years to repay. Borrowing money isn't necessarily a bad thing. Many successful companies use debt to expand, build new facilities, or invest in future growth. The important question is whether they can comfortably repay it. As a shareholder, that's something you'll always want to understand. Now we reach shareholder equity. Remember, when you buy shares, you're becoming one of the owners of the business. Shareholder equity is the portion of the company that belongs to its owners after all debts have been paid. That's why the accounting equation works. Assets equals liabilities plus shareholder equity. Every balance sheet must balance. Now, let's put everything together. Our simplified Costco balance sheet contains three numbers. Liabilities, $60 billion shareholder equity, $40 billion. Add those together. $60 billion plus $40 billion equals $100 billion. That gives us the company's total assets. So our completed balance sheet is liabilities, $60 billion plus shareholder equity, $40 billion equals total assets. $100 billion written as an accounting equation, that's assets equals liabilities plus shareholder equity, or using our numbers, $100 billion equals $60 billion plus $40 billion. This is why accountants call it a balance sheet. Both sides of the equation always balance. Whenever you're thinking about buying shares, ask yourself these 5 questions. Does the company have plenty of cash? Is its debt manageable? Can it comfortably pay its short-term bills? Is shareholder equity growing over time? And finally, based on what I've seen, would I feel comfortable buying shares in this company? These questions won't tell you everything, but they'll help you quickly identify financially stronger companies. Let's recap. A balance sheet is a snapshot of a company's financial position today. It tells you what the company owns, what it owes, what belongs to the shareholders. Before buying shares in any company, spend just a few minutes looking at its balance sheet. It won't tell you everything, but it will tell you a great deal about the financial strength of the business you're about to become part owner of. Combined with the income statement, you now understand 2 of the 3 most important financial statements every investor should know. In the next video, we'll complete the picture by learning how to read a cash flow statement and discover where a company's cash is really coming from. If you found this video helpful, please like the video and subscribe. It costs you nothing, but it really helps the channel. Thanks for watching, and I'll see you in the next video.